All right, let's just dive right into this explainer. Today, we're unpacking the trillion-dollar machine that is JPMorgan Chase. If you've ever found yourself wondering what's actually happening behind the scenes when you swipe your card, or when you hear about these massive multi-billion-dollar corporate mergers, well, you are in the exact right place. We're going to look under the hood of a true financial titan. Now look, at first glance, this official 181-page SEC document, the Q1 2026 Form 10Q, it looks, well, incredibly dry and intimidating, right? It's just packed with dense regulatory jargon, endless tables, and tiny footnotes. But we are going to translate this dense paperwork into a kind of financial detective story. Because buried right here in these pages is the exact blueprint for how global capital actually moves. To keep us perfectly on track, we've broken this complex filing down into 5 quick chapters. The trillion-dollar machine, where the money originates, the cost of doing business, fueling the broader economy, and finally, the 2026 financial outlook. All right, let's hit Chapter 1, the trillion-dollar machine, and get a real sense of this bank's scale. $16.5 billion. That is the total net income JPMorgan Chase pulled in during just the first 3 months of 2026. I mean, think about that for a second. That's a massive 13% jump from the year before. When you break those numbers down, they're clearing billions of dollars in pure profit literally every single month. It is just a stunning display of financial momentum. But to actually generate that kind of income, the bank leverages a mind-boggling $4.9 trillion in total assets. Seriously, what does 4.9 trillion even look like? It's a scale so massive it practically acts as its own economy. To put that into perspective, if their balance sheet were a country's GDP, it would easily be one of the largest economies on Earth. They aren't just participating in the financial system, they essentially are the underlying architecture of it. Moving to Chapter 2, where the money originates. Let's start tracing that $49.8 billion revenue and see where that river of cash actually flows from. So the real crucial point to grasp here is NII, or net interest income. This is the absolute core engine of traditional banking. It's basically the profit made from the spread on interest rates. In other words, it's the difference between what the bank earns by charging interest on things like mortgages and credit cards, minus what they pay out to you for keeping your money in a savings account. For this quarter, their NII hit $25.4 billion, up 9%, mostly driven by higher deposit balances and people keeping more revolving debt on their cards. But what's really fascinating is how beautifully balanced this revenue engine is. It's split almost perfectly down the middle. You've got that $25.4 billion from traditional net interest income on one side, and right next to it, you have $24.5 billion from non-interest revenue, which actually jumped 11%. That non-interest side, that's all your fees, asset management, investment banking, even auto operating leases. This dual engine setup is exactly what gives a bank this massive its incredible stability. If interest rates get weird, they just lean on that massive fee-generating business. When we look under the hood at the specific divisions driving this, the efficiency is just wild. Their asset and wealth management division is churning out a 44% return on equity, meaning they're incredibly good at turning their capital into profit, all while managing a staggering $4.8 trillion in assets. Then you've got the commercial and investment bank division, sitting at number 1 globally, grabbing nearly 10% of the entire global investment banking pie. Add to that a 7% jump in active mobile customers on the consumer side, and yeah, they are dominating literally across the board. Okay, Chapter 3, the cost of doing business. Because it takes money to make money, let's shift gears and look at the exhaust and maintenance required here. It cost them $26.9 billion just to keep this trillion-dollar machine running for one single quarter. And as you can see, human capital is by far their biggest investment. Of that nearly $27 billion, a whopping $15.3 billion goes straight to compensation. That's hiring front office talent and paying out revenue-based bonuses. You also see $3 billion poured directly into tech and communications. These days, tech isn't just IT support. It is literally the foundation of their competitive edge. Throw in another $1.6 billion just for marketing to keep those new customers flowing in, and you start to realize how incredibly expensive market dominance really is. There's also another, slightly hidden cost of doing business. Even a financial titan has to brace for impact, so they set aside $2.5 billion this quarter just to cover potential loan defaults. Actually, looking at the data, there's a really heavy focus here on credit card losses, with a net charge-off rate hitting 3.47% in card services. This is a super important metric. It tells us that, sure, the bank is highly profitable, but they're also pragmatically acknowledging that some folks won't be able to pay them back, and they're padding their balance sheet just in case.
Let's pivot to Chapter 4, Fueling the Broader Economy, and look outside the bank's own walls at the real-world impact.
The numbers here prove they aren't just hoarding money in a giant vault somewhere. They actively pumped $855 billion into the economy in Q1 alone. This is exactly what we mean when we talk about a bank being an economic engine. We're talking new and renewed credit and capital raised for everyone from everyday consumers to massive multinational corporations. And breaking down those priorities is super revealing. While everyday consumers got a massive $72 billion and small businesses saw about $8 billion, an absolute mountain of cash, $750 billion, went straight to corporations and non-U.S. government entities. That capital is the fuel for major global business moves, infrastructure, institutional trading, the whole shebang. It really shows you where the true center of gravity is for their operations. It's firmly in the corporate and wholesale world. Finally, Chapter 5, the 2026 Financial Outlook. Let's see what management actually expects for the road ahead. So, directly from the executives, they project their core traditional banking engine, that net interest income we broke down earlier, will pull in around $103 billion for the year. That is a jaw-dropping forecast for just half of the revenue stream. But, and this is crucial, they also project that keeping the lights on will cost slightly more than that at around $105 billion. It highlights a fascinating reality. The pure, raw cost of operating a bank at this scale actually outpaces its colossal net interest earnings, which perfectly explains why those non-interest fees we talked about are absolutely vital to their overall profitability. Now, if you dig really deep into the filing, there's a surprising little wild card for the upcoming second quarter, a pending Visa stock exchange offer. The SEC report notes the bank has tendered 18.6 million Visa Class B2 shares in an exchange offer. Once Visa accepts, the bank expects this to trigger yet another massive financial gain recorded in Q2. It's a great reminder of why we actually read these dense documents. There are always these hidden levers and strategic moves tucked away in the footnotes that end up moving the needle by millions or even billions of dollars. So, we've seen the raw data, we've seen the staggering trillion-dollar scale, the perfectly balanced revenue streams, and those massive injections of capital into the global market. But I'll leave you with this provocative thought to chew on the next time you swipe your debit card or read the market news. Are a bank's record-breaking multi-billion-dollar profits the ultimate indicator of a booming, healthy economy for all of us? Or is it simply a sign of corporate dominance in an increasingly consolidated financial system? It's definitely a question worth asking as we continue to watch this trillion-dollar machine roll forward.